Hello, this is Chuck Carnevale, and with today's video, I'm going to do a FastGraphs Fundamentals Analyzer software tool review of the valuation relationships over the long run on Kroger. I chose to do this particular video because I believe it offers several very important insights into the importance of valuation and how valuation can affect investor returns over the long run. I'm going to start out with looking at Kroger's long-term adjusted operating earnings history. I'm going to be using several metrics that relate to valuation in this video. I'm going to start with operating earnings because there's a lot of insight that you can gain by looking at a company's long-term operating history. As you can see, there's a moderate amount of cyclicality in Kroger's earnings. There were two down years here in 1998 and 1999. And then interestingly, the company's earnings growth was actually pretty strong prior to and going through the recession of 2001. Then they had a couple of down years. And one of the reasons for this cyclicality, I might interject here and I'll cover more later, is that grocery stores tend to operate on very razor-thin net margins, even though their gross margins are pretty good. Then from 2005 into the Great Recession, actually through 2009, the company's earnings growth was again very attractive. You can see the rates of change of earnings growth down here at the bottom. Then they had a couple of down years of earnings. And then from 2011 through 2016, earnings growth was actually very strong. Once again, you can see some really good rates of annual rates of change of earnings growth down here at the bottom of the graph. And then more recently, they've announced some softness in their earnings going into 2017 here, which obviously their fiscal year ends in January of 2018. And then forecast for some moderate growth going forward there. So there's a lot of cyclicality, although it's moderate cyclicality in Kroger's long-term historical operating history. To highlight some additional operating results of Kroger, I would then next like to add dividends. The company started paying their first dividend in 2007, as represented by this white line here. I want you to know the dividend growth was very strong. It's averaged over 13% a year. And I'm going to then take this area down here below this white line, which is the portion of earnings that Kroger has paid out to shareholders, and stack it on top to illustrate that total return is a function of capital appreciation or loss as a result of the price moving from point A to point B, plus whatever dividend income a company generates or that the shareholder might receive. So now where this really gets interesting is let's now overlay monthly closing stock prices onto the graph. And what I want you to see here is that there is a very high correlation between Kroger's long-term stock price and their adjusted operating earnings. You see periods where we had some significant overvaluation. You see periods where the price was undervalued relative to this orange earnings justified valuation line. And then, of course, the Great Recession, as it did with many companies, created several years of low valuation before Kroger's stock price really began to accelerate from the beginning of 2012 up through 2015. But this represents another significant overvaluation level. Now, I also want to add the normal PE ratio because I think this is also important. What you see here is that Kroger has historically traded at I'm going to say a 15 normal valuation level, and it's currently trading at a blended PE of only 11. That's the undervaluation I referred to in the article. However, as I previously suggested, there are other valuation metrics that I think should be looked at and analyzed. And here we have operating cash flow. And what I want you to notice is this company has traded at a normal priced operating cash flow of about 6.4, and it's currently trading at a priced operating cash flow of only 5. What's I think significant about this particular view is that the company generates significant cash flows well above what they need to support their dividend. So I consider that a consideration. And then next, I'm going to look at Kroger's valuation from the perspective of EBITDA, earnings before income taxes, depreciation, and amortization, or what Warren Buffett once referred to as earnings before all the bad stuff. And you see a very, very interesting correlation here with EBITDA. You'll notice that the normal price to EBITDA for Kroger over this time frame has been about 4.7 times. And when I use EBITDA, I only use the normal calculation. The current price to EBITDA, blended price to EBITDA, is 3.7. So you have all these valuation reference here that give clear indications of when the price is significantly overvalued, like it was on these two occasions, moderately overvalued here, and you also get clear indications of when Kroger's stock price was undervalued, as I believe it currently is right here. So valuation is a very important consideration relative to whether an investment makes any sense or not. And as I mentioned in the article, it also really highlights what I call good losses versus bad losses. And as I pointed out, there are no good losses, but a loss generated from overvaluation is a really bad loss because it can take years and years to recover. For example, let's look at how overvalued Kroger was on February of 1999 when the price simply made no sense. It wasn't justified by the operating earnings. And then look out, several years, going here 8-10 years or so. Actually, it's probably 15 years. And you see that the actual rate of return was negative, minus 3.6% annualized. You would have actually lost 39% of your money. And of course, they didn't even start paying the dividend until 2007. So really, this is what I call a really bad loss. This loss from this point right here, where it was at a massive overvaluation, to this point, which represented a loss of over 45%, is really a bad loss. That's a loss from overvaluation. In contrast, if you had measured it where it was reasonably priced in June of 2002, and at this point the stock fell 34%, that was not a great loss, but you can clearly see here that if you go out several years, even prior to the Great Recession, there was a positive rate of return. But rate of return is a function of growth and valuation, and you can see here that there wasn't a lot of growth in Kroger during this period of time. But this is a much less severe loss than this loss of excessive overvaluation, and that's the primary point I'm trying to focus on. Now, the same is true when you come into more modern times. I'm going to go back to adjusted operating earnings here and leave EBITDA for a moment and do a similar exercise with operating earnings. When you look at how undervalued Kroger was back here in August 31st of 2012, it was trading at a 9 PE, where the normal PE had clearly been in the 14 or 15 range. And then you had this incredible rate of return period here from its low valuation to maximizing out to its highest valuation here. You could have actually made 48% annualized, even though the stock, though it grew faster than normal during this period of time, there was nothing really materially different. It was a function of buying the stock at a low valuation and having it go to a high valuation that would have created that kind of return for those fortuitous enough to have invested in Kroger and continued to hold it. But then we had a couple of losses here that I think need to be highlighted or should be highlighted. We have this first loss, which started in December of 2015 and then culminated in September of 2016, where Kroger's stock price fell 29% from an extremely inflated valuation to a moderate undervaluation. And I want you to notice there was a short-term rally during this period of time, where Kroger's stock price for a small period of time actually increased by 16% from September 2016 to December 2016. But then this is the second loss that I'm talking about, and I'm going to measure it from what I'm going to call approximate fair value here, where the PE was 15 to its current undervalued level of 11, and you can see that this generated a 27% loss. It's actually a 59% annualized, but it's a pure 26.7% loss since February of 2017. Now, I don't consider this loss anywhere near as catastrophic as the loss from here to here, because as you can see, it could take years and years for investors to recover their money. But from here, where you have this 11.3 blended PE, if Kroger were simply to move back to its normalized 15 PE ratio, let's say by January of 2019, that would be a 32% gross return or a 21% annualized rate of return, this is the opportunity I was referring to in the written portion. Now from here, I'd like to move into some forecasting and look at Kroger from a perspective of its normal PE ratio. This drop-down window here allows me to review all these various historical normal PE ratio levels for this company going back for 18 years. Now, there's no forecasting data in these numbers. These are strictly historical calculations. And it should be very clear that the lowest normal PE was 13.7 over this time frame, and that was the 8-year normal PE ratio. The highest PE ratio was 18.2, which is obviously aberrant and excessive, which was a function of the last 2 years due to that overvaluation we cited earlier. But I think, we can even conservatively settle on a 14 normal PE ratio and call that kind of a low case example. And if that were true, then again, you see these incredible rates of return if Kroger was to move back to its normal PE ratio with very little growth forecast going forward for the next year to year and a half or two. What you have here is, in essence, almost a leveraged opportunity. The PE expansion can create some very significant short to intermediate rates of return going to Kroger, over the next several years if it reverts back to a normal PE. If it gets, back to a 15 PE, those rates of return get into the 24% range. So I think this is an incredible opportunity. I think the Amazon fear, which is what really precipitated this final drop here, is way overblown. This company has been in business a long time, and I think it'll continue to be in business a long time, regardless of Amazon or not. I think most people still like to go to their grocery store to do their shopping. Now, I would like to take a real quick look at some financial underlying numbers here that I think are really important. The first thing I would like to look at is gross and net margins. And I'm going to shorten this time frame for the last 7 or 8 years here. It's important to recognize that grocery stores have razor thin margins. Their gross margins, in the case of Kroger, are comfortably in the 20 to 23% range. Their net margins are in the 1 to 1.5 to maybe as high as 1.8% range, and the margins have actually been a little higher recently than historical norms. But grocery stores, and if you really analyze the first graphs I showed here, you can see that these margins had a great deal to do with the profitability of the company. Their net margin is actually a little stronger than normal currently, which indicates to me that the company's fine on a profitability range. So to summarize what I'm suggesting with this video, I think Kroger offers some really great lessons in valuation. This is not a great growth stock, but historically its growth has been relatively consistent. Over this period from 1998, it's averaged 7.6. If I shorten the time frame, the growth is a little higher because we had some high numbers in here at 9.3. I drop it to the 10-year graph, it's 9.8. I drop it to the 7-year graph, it's 7.6. And I'm just going to simply also then go to my historical growth rate graph here on the forecasting calculators and use the drop-down window to illustrate that this company's growth rate is consistently in the 7 to 9% range, and on occasion it can get higher into the double-digit range, and that's the nature of a cyclical company. Nevertheless, I believe this is a very undervalued stock at this point. I think it makes a lot of sense. I think this last loss was an opportunity for anyone that did own the stock to buy more shares. This has been Chuck Carnevale saying I hope this gave you some insights into the importance of valuation. Thanks for watching, and I'll talk to you soon.